Morning, everybody. It's a privilege to stand before you on our 34th anniversary year. It's hard to believe that we've been doing it for that long, but a lot's changed in the last 34 years, but a lot's really stayed the same. And we're going to touch on that. And then, of course, we have our esteemed speaker, Jeremy Siegel, be updating everyone. We will take questions. If you have a question, we'll have microphones on both sides. They'll come to you because it's kind of a big place as far as that goes. A few years ago, a friend of mine was walking with his daughter, and she was about 5 years old. They came to a bridge that was pretty beat up, and she said, "I'm afraid to walk across it." And he told her, he said, "Well, just hold my hand and we can walk across together." And she said, "No, I want you to hold my hand." And he said, "Isn't that kind of the same thing?" And she said, "No, because if I hold your hand and I get scared, I'm going to let go. But I know you're not going to let go of me no matter what." And I think that's really kind of the core of what our purpose is to kind of walk people through all the challenges, opportunities that present themselves. I mean, the reality is we're here to provide financial planning and wealth management, but ultimately that's just a means to an end. Money's just a tool for achieving the life that we want to live and hopefully becoming the best versions of ourselves. So our job, is to help make people's lives better, whether it's helping with the investments, it's planning a trip, it's providing information on leasing versus buying a car, finding a babysitter, but pretty much anything that's out there. But as I stand here, it's interesting to reflect on how far we've come over the last 30 years, but also where the opportunity is going forward. And planning, obviously, for all of our clients is important. It's also important for our firm as we go forward. Now, I have no plans to retire at any point, but it's always been important to be prepared for any contingencies. We've had a written succession plan in place for over a decade. We've got business continuity plans in place. And one of the things is, as other firms move to technology to replace people, we continue to add to our team. And moreover, we're trying to bring in another generation of advisors. And I think this multi-generational approach will ensure that we're here for children, grandchildren, and down the road. So in 2024, we added 4 new team members. Perhaps a more important milestone just happened on January 1st. Raj, Dan, Nick, Gail, and Bobby became equity partners in the firm. So we went from basically a sole owner firm to a partnership. And I think it's not just a financial commitment on their part, but also a personal one. And this step recognizes not only their outstanding contributions, but it really reflects our collective commitment to the future. So for all of you guys, I know some of you have been with us 20, 30 years. I want to thank you for being part of the journey. And together, I think we've built something that's truly incredible, but it's just going to get better. And so we're at a very interesting point in history where technology is emerging faster than ever. There's a lot of talk, with geopolitics and the economy. We have a new administration coming in. This year, we had 50 billion people vote in elections around the world in 2024. It's the first time that's ever happened. And yet, while there's changes, what we see is the 2 challenges, the 2 mistakes people make the most have stayed the same. And the first one's making bad decisions, either because of fear or greed or misinformation. And I started, a lot of our role was getting information to people. The internet didn't exist. You were lucky to get a 401k statement once a year. Now, it's like drinking from a fire hose. It's 24/7, and we're inundated with a lot of information. And a lot of it may not be complete or accurate. And then the second risk, and you guys have heard me talk about this forever, is inflation. A dollar tomorrow is not going to buy what a dollar today does. We have a lot of people, some of you, I'm sure paid more for the last car you bought than the first house you bought. And we started, a postage stamp was 22 cents. In 2025, the forever stamps are going to 73 cents a piece. That's a 300% increase over time. So I think, the role of the media certainly is not to inform, it's to sell something. And we've gone from, I remember it was basically 3 TV stations, ABC, NBC, CBS, and then a bunch of stuff that didn't really work on the UHF. But now you've got thousands of internet sites. You've got thousands of cable TV stations, and they're all competing for attention. And so they're always going to put out the dramatic and the short term. And I'll give you an example. Violent crime in the United States today is down at a 50-year low, according to the FBI. It's the lowest it's ever been. And yet, when you turn on the TV, all you hear about is mass shootings and stabbings and people being pushed in front of the train and the subway. And the reality is, it's down. It's just our perception gets tipped because of the media. And hopefully events like today can cut through some of the noise and give a little bit clearer picture. Our vision, our mission has always been to make lives better, our clients, our community, and our team. One of the things that we had always focused on was hunger in Lake County and also some of the homelessness. And for years, and you guys participated, food drives, helping us. We used to do shredding days. But about 4 years ago, we realized at best we were treating the symptom, and at worst we're just enabling people. And we wanted to look at the root causes in our county of hunger and homelessness. And part of it was people who wanted to work often had trouble doing so because of transportation, daycare, housing. So we created something called the New Beginning Initiative, and it's geared for people who actually want to work. They're not looking for something free. They're not looking for a handout. And then we help them do so. So that's our Carver Cares partner for today. You'll see some information on them and all of our philanthropic efforts in the handouts that we provided. But I think it's an important mission to try to help people who actually want to help themselves. Now, as I said, technology is incredible. It's powerful, but it also poses risks as to both personal information and misinformation. What I can tell you is both Raymond James and ourselves take data security very, very seriously. I know sometimes it's frustrating getting into things. That's because of the security. Raymond James is the only firm on Wall Street that has a written guarantee that if you're hacked, they will reimburse you. And, as I say, we're trying to provide information that's pertinent to your situation. Now, obviously people are talking about AI. It's interesting because if you look at the impact of technology, and specifically AI, I think it's the biggest paradigm shift since the internet. It's been said that AI can contribute about a 21% net increase to our GDP over the next 5 years. In our office, we do use a lot of AI, but we do not use it to make investment decisions. We don't use it to trade, and we don't use it to fire out automated kind of communications. When you phone, you're still going to talk to a person. We don't have voicemail. I think it's critical that you're speaking to somebody. Our investment committee absolutely uses algorithms technology to monitor portfolios and investments, but all of the decisions are made by the group collectively as individuals. And likewise, when we meet with you and we discuss your situation, the planning's based on you, not on a model or something else. And I believe, again, properly used, the technology can enhance personal relationships as opposed to replacing them. Now, the fact is markets are volatile. Markets can assimilate bad news. They don't like uncertainty. The next 100 days, I think we're going to see a lot of uncertainty with the new administration. The fact is, if we go back historically, the markets drop 10% on average about every 8 months. That'd be roughly a 4,000 point drop today. The media would lose their minds. But the reality is this has happened in the past. People always feel like this time it's different. It really isn't. And the problem is, and you've heard me say this again for decades, trying to time these things is impossible. And it can be very, very expensive. In fact, 96% of market returns are made in about 0.9% of the days. If you miss just a few of the best days, it has a huge impact on portfolios. Now, we can tell you what we think is going to happen, but we can't tell you exactly when it's going to happen. And if you look back from 1995 to 2022, over 27 years, if you missed just the 30 best days, you made about 1% a year, whereas the market made close to 8. If you missed the 50 best days, you actually lost money, had less money than you started with after 27 years. So no doubt you're going to hear about how tariffs are going to do this and the war is going to do that. And we've never seen this before. It's nothing new. As Warren Buffett said, the 4 most dangerous words are this time it's different. If we look back, the deficit monster, the economy, that covers from 40 years ago. That's 1984. The other thing we're hearing about now are the hostages and the negotiation in the Middle East. With the turmoil, Israel rolling into Gaza. Those covers are from 1974. It's 50 years ago. So a lot of these things really don't change. As I say, I think one of the biggest risks is inflation. We have to grow our money to keep out of taxes and inflation. And people are living longer. I just looked today, we have 44 clients over the age of 90, a handful over the age of 100. People used to retire at 65 and die at 70-something, and now they retire at 55 and they never die. You know, go on and on. So I think, volatility presents opportunity if used properly. Your advisor will work with you to take advantage of that. Obviously, if you have questions or concerns, you can always reach out to us. As I say, we do have a pretty intentional approach to planning that's really been developed and refined over the last 30 years. But it all comes down to what's important to you. So it's important to communicate to us changes, what you're concerned about, what you need, and then behind the scenes, there's a lot of work going on to deal with those types of things. We also recommend family meetings. We don't necessarily have to tell your kids how much you have, but your beneficiaries, your heirs, especially if they're your power of attorney to take care of you prior to when you die. It's important that they know what are your values, what's important to you. And we can certainly help facilitate those types of meetings for you. I associated with Raymond James in 1990. At the time, they were called Investment Management Research. I had been at a firm where we were very limited as to what we could offer to clients. I didn't want to be pressured to sell the product of the day or be narrowly defined. We also wanted to be able to have the resources of a Fortune 100 company, a trust company, a bank, experts that we could rely on to review documents. People would have questions about things I had someone call the other day about taxes in Chile. Not something we're an expert on, but we can get somebody. So we associated with them in 1990, and it provides you with access to hundreds of experts and resources like the bank, like the trust company, et cetera. Our website is another thing I'd encourage you to check out. The communications, the blog every month. Every one of these events is videoed and is available going back. Any of the upcoming trips and things are there. All of our client communications, the newsletters, the memos, et cetera, are available to you on the site. If you have questions, you can certainly call our team on how to navigate that. Other resources, again, shredding documents anytime. We don't do the shred days anymore. We have meeting space for you. We can medallion guarantee documents. Again, everything from mortgages to lines of credit. Discounted third-party services like identity protection. We have 2 affiliations for concierge medical locally and then nationally, and other types of things like that. We have an expert on Medicare, so just reach out if you have questions. But again, this is there for you. I encourage you to take advantage of all of those things. As in the past, we have a number of events coming up this year. Again, they're listed in the client memo. They're on our website. The next broader event that I'd mentioned to all of you is April 17th. We're doing the singer-songwriter concert. It could be right here. It's a lot of fun. You'll hear from people that have written the songs and then they play them. We have Josh Keir. He's 18 Grammys. He's written a number of songs that I think pretty much everybody's familiar with. And then we have hopefully Natalie Hemby coming. She wrote the theme to A Star Is Born, Lady Gaga sang. She wrote Watermelon Moonshine. She wrote a number of things. So that's April 17th. Can bring family and friends. We have our singles event, May 15th. Got our annual golf outing in June, which is already filling up. Our client appreciation baseball game, July. And then, of course, we have our trips. Some of you are fortunate enough to be going next week before it gets cold to Jamaica. And then the trip we just announced is January 2026, be Turks and Caicos. And then summer 2026 looks like it's going to be Alaska. So lots of stuff coming up there. Obviously, the most important resource that we have is our team. Reach out anytime you have questions or there's anything you need. And a lot of times, you don't have to call your advisor. Anybody picks up the phone can assist with things like balances or getting cash, ordering checks, those types of things, registering for events. So I hope all of you will take advantage of it. I appreciate you being part of this. And with that, it's truly my pleasure to introduce Dr. Jeremy Siegel, who's one of the foremost experts in economics and finance. Dr. Siegel's been a professor at Wharton School of the University of Pennsylvania. He wrote the acclaimed book, Stocks for the Long Run, which I think is in its 6th edition now. It's been updated. And obviously with decades of research, Dr. Siegel's become a trusted voice on market trends, investments. You may have seen him on CNN, CNBC, heard him on NPR, or seen him in Kiplinger's. So with that, Dr. Siegel.
Thank you, Randy. Thank you, Randy. It's good to be near the Great Lakes again. I grew up in the northern suburbs of Chicago. It's a different lake, of course, but Randy and his group and I, we had dinner last night, and I got lake trout, which in the East we don't get, or it isn't as good. And so it was really quite a pleasure to be back in the so-called Midwest again. While lots is happening, and we know 2 days we're going to have a new president, and let's hit that on what could happen there. We're going to start out with the big view, and then talk about where we stand today and what kind of returns we can expect into the future. As Randy mentioned, 6th edition, Stocks for the Long Run. First edition came out in 1994. And we've sold about 1/3 copies over that time period, which is pretty good for a book that has about 550 pages and about 800 charts and tables in it. But it's culminated so many years of my research. Let me show you, just after a couple of that, the most important chart of all in the book. The long run real accumulation of wealth in the major classes of financial assets, stocks, bonds, treasury bills, gold, and the value of the dollar itself. I went back further than any other researcher. Beginning of the 19th century, 1802. Took me over 2 years to research all these returns. And I asked the question, if you put $1 in one of these asset classes, reinvested all the dividends, all the interest, let your wealth grow, don't take anything out, measured after inflation, that's what the term real means. Because that's all that counts is after inflation. How would your wealth grow? The top line is a diversified all index of stocks. Single dollar grows to over $2.6 million of purchasing power. And by the way, we update this once a year. So you guys are actually the very first to see the update through 2024 at the end. A single dollar in U.S. government bonds with interest reinvested gives you $1,326 of purchasing power, in Treasury bills, $243. In gold, $5.16. Stays ahead of inflation, but not by much. And the dollar itself, what it could buy. $1 could buy $1 in 1802, and by the way, almost $1 all the way until the 1930s, 40s. But look what's happened since then. Now buys less than 4 pennies in purchasing power. What are the compound rates of return over here? This is the average annual compound after inflation rate of return in these asset classes. For stocks, 6.9% per year. It is a bit above the trend line. We're going to talk about it. Look at that trend line. Look at the way real stock returns cling to the trend line. I remember after the second edition of Stocks for the Long Run, one reporter came up and they said, "Dr. Siegel, this is a great book. Can you summarize it in one sentence?" And I was challenged at the time, but a little later I called him back and I said, if there's a sentence that summarizes my book, it is the following. Stocks are the most volatile asset class in the short run. We all know that. Days up, days down, bull markets, bear markets. But it is the most stable asset class in the long run. Look at that line. Look at that trend line. No other asset class follows the long-term trend the way stocks do. Very important to keep in mind when, of course, the media loves to amplify all the volatility that is in the market, and it scares people out of it. All those little wiggles, what are they? The great bull and bear markets over time really sort of fade into insignificance compared to the upward thrust of values. Bonds average annual real return 3.3. Now, by the way, as I'll tell later on, I think both are going to be lower in the future, but stocks will still have a big edge over bonds. Treasury bills 2.5%, gold 0.7%, and the dollar depreciated 1.5% a year, almost all of it over the last 80 years since World War II, where the depreciation has averaged between 2 and 3% a year, pretty much where we are today. Now, there's one thing that's, it's so many good things to talk about. You could talk about history, the gold standard, all the rest. I could give you a monetary lecture on it, but I'm not going to. I'm going to give you what I think is the most important point to think about with this graph looking into the future. As noted, almost all the inflation, the depreciation of the dollar has come in the third subperiod over here since the vertical line, since 1940. Now, take a look at the stock line. Has that inflation that has sent the dollar from being worth $1 to 4 cents, that's more than 2,500% cumulative inflation over that period. Has that had any negative effects whatsoever on your after-inflation rate of returns in the stock market? And the answer is absolutely none. Now, what does that mean? That means over the long run, and Randy talked about inflation because that's certainly something that we have to worry about. In the long run, stocks are perfect hedges against inflation. Not necessarily year for year. There's nothing that's a perfect hedge on a year-for-year basis. But if you're looking at the long run and you're worried about inflation with all the deficits and everything else, people ask me, what should I be in? And the answer from history is clear. It is stocks. And why is that? Because stocks are claims on real assets, plant, equipment, land, copyrights, patents, intellectual property. All those are real assets. Bonds are only promises to pay dollars with no promise whatsoever about what those dollars will be worth. The only U.S. government bond that makes a compensation for that is the TIPS bonds, the Treasury Inflation Protected bonds, whose yields are much lower, in the low 2s at the present time. Way lower than the historical, or in my opinion, even the prospective returns in the stock market. So, I was not at all surprised to find that effect, that stocks were not affected at all. Bonds were, but stocks would not be. I said that 30 years ago, 1994, when the first edition was there. And over the last 30 years, absolutely has still held. And it held for very, very good reasons, both empirically and theoretically. All right, let's talk about some Trump's policy. Yeah, Trump is the most pro-stock market president in history. That doesn't mean the stock market's going to be the best in history over the next 4 years. We attribute so much to the president about what happens in the economy, and some of it should be, but a lot of it is really beyond their control. We live in a capitalist economy. There are business cycles, there are external events over which the president and administration does not have control. As a result, just because he's the most stock market president and wants to pursue those, which is a very excellent thing to be sure, does not guarantee in any way the market has to go up over the next 4 years. Or we could get above normal returns. What about the Fed? You know, he made earlier comments about not being happy with Jay Powell. He's happy with Jay Powell now. I mean, Jay Powell kept the economy and stock market good and elected him president. But there could be a conflict in the future. If something bad happens and the economy goes on, you know, Trump could say, hey, lower interest rates. And Powell could say, but that could be inflationary. We haven't finished fighting inflation. That's where the tension can be. Not now, not in the near future. I don't see that in the near future. I'm just saying what could happen. Now, Powell actually has the chairmanship of the Fed until the middle of 2026, at which point President Trump can remove him and, his term is up, and pick his own chair. Actually, he cannot remove him beforehand without an impeachment process, which has never been done on a Fed official and certainly would not be warranted under current circumstances. So there could be conflict later on if things get rocky. At this point, I think, he is very pleased, with how things are going. Listen, we live in a pretty Goldilocks economy. Certainly we're not down to 2%, but we brought it down a lot and maintained good growth, which many other economists, although I said that was possible, many others said that was impossible, that we could bring down inflation from 8 to 2.5% and not cause a recession, and we've been able to do so. So we're living in a really good economy in that sense. Worried about the deficit? We're going to talk more about the deficit. You know what the bond vigilantes are? Have you heard that term? Those are the traders of the 10-year government bond, which is considered the benchmark. And what they are is they look over the budget, and if they see too much of a deficit, they start backing away from bonds and interest rates go up. I have maintained for 30 years. People ask me, Dr. Siegel, when is Congress ever going to wake up and do anything about the deficit? With all this research and all the rest, I said there's only one and only one thing that will ever cause Congress to move on the deficit, and that is if interest rates on those long-term bonds start moving up, threatening the economy, plunging the stock market, plunging housing, and all that. That is the only thing. When that starts happening, it doesn't happen. Some people talk about, a crisis in the government bond. No, it doesn't have to be a crisis. It just means interest rates moving up to 5, 5.5. No, that's not so bad. 6, okay, 6.5, 7, 8, whoa, 9. Whoa. Many of us forget. Ronald Reagan, who was an excellent president, came in, cut taxes, as he should have, but went a little too far. Guess what? The bond market started raising interest rates. He had to go back in history. He had to actually reimpose some of the taxes until the deficit got more settled down. Interest rates started plunging, and we, enjoyed some of the biggest prosperity we ever had in the next 8 years. Go back in history. That had happened. So there was those bond vigilantes saying, hey, that cut was too big at the beginning. He didn't want to call it a tax hike again. He called it revenue enhancements. I remember that back in 1981 and 82, kind of moving back. So it's happened before. It happened in big picture in Great Britain. If you remember a year ago, the conservative Liz Truss, she thought she was a new Margaret Thatcher, and she said, I'm going to boom the economy. She cut all taxes 20% with no revenue sources. You remember what happened? The bond market just completely kind of collapsed. Interest rates went up. She was the shortest term prime minister in the history of the United Kingdom. She was gone. So, again, the bond vigilantes in the UK just, that's it. It can happen to anyone. That's why. But it's only going to happen. Nothing else. No, I can give you graphs and numbers and all that. Means nothing. The only thing that will mean anything is those interest rates rising. All right, and they have begun to rise, haven't they? Sort of putting Trump on notice We like your tax cuts, but don't go too far. I think the 2017 tax cuts, which were excellent, will be renewed. I think all the other ones that Trump promised is a question. Bringing back the state and local tax deduction, no tax on tips, no tax on Social Security, you name it. We'll talk a little bit about what that means. That's going to be harder. The bond market will tolerate an extension of 2017. But by the way, those tax cuts, as you know, all expire at the end of this year. So it has to be. And of course, there's all what strategy should he use? How should he do that? He could get 2017. All those other ones are going to be more questionable and harder, especially because, as you know, the margin in the House is not that big. Tariffs. By the way, people say he's going to impose tariffs on day one. I mean, he made the statement, I'm only going to be a dictator on day one. Well, that's 2 days away, right? Or 3 days if we count the day after inauguration. Well, actually, the mechanism is a little different. He can authorize the imposition of tariffs. Then the Department of Commerce is supposed to report back, yes, they are in the security interest, and you are authorized to do that, and then he can start imposing them 30 days later. My feeling is it's going to be a much longer rollout process. People think, on Tuesday of next week, all of a sudden we're going to, we're going to get a huge increase in tariffs. They're going to be much longer. But it's going to be important. My feeling is wants to use it as a bargaining chip, and that's fine. The exact levels, we really don't know on that. And of course, the big uncertainty on deportation, how is that going to be done? I mean, it affects certain industries, agriculture and housing. Construction in general uses a lot of immigrants, some legal and some not. And how is that actually going to happen? So there are these two uncertainties, and not all going to be resolved by Monday and Tuesday, certainly. It's going to be playing out over the period on there. So those are things that are certainly facing the market. What about interest rates? Let's go back. So there's some number that the Fed calls R star, sometimes called the neutral rate of interest. R star is the long-run rate of interest at which everything is balanced. Supply, demand, not too hot, not too cold, just right. All right? That's the long-run goal. Now, the Fed thinks that R star over the last year has risen. Yeah. The Fed indicated in its December meeting that it thought that R star, and by the way, when I talk about this, I'm talking about this short-term interest rate, the Fed funds rate, not a long-term bond. It doesn't have direct control over that at all. There are a lot of factors determining it. But it does control absolutely to the penny what that Fed funds rate is, right, which is a short-term interest rate on that. Now, I'm going to move ahead. I'm going to show you, they come out with survey of economic projections 4 times a year. By the way, the January meeting is not one where it comes out. We're going to have another January meeting in a couple weeks. That will not come out with this. But a longer run, what they think the long-run change in real GDP is 1.8. We're running above that now. 4.2, we're just about at that level. Inflation, of course, the 2% target. And then go down to the bottom. Fed funds rate, 3% they think is a long run. I've been disagreeing with that for a long time. I think it's much higher. Well, much higher. How much higher? Let's go back to over here. I think it's somewhere between 3.5 and 4. All right. By the way, where are we right now? Let me just tell you. Right now, we're at 4.33. So we're a little bit above that level. That means we're a little bit restrictive. Not much. All right? Let's talk a little bit about, everyone talks about how many cuts we're going to have there. Let me just start out at the beginning to tell you that no one knows, including the Fed. All its projections, the dot plot and all that you hear about, might as well be written on tissue paper. I mean, it has, if you go back in history, almost no correlation with what happens. They just look at what's going on. If inflation and the economy seem so strong, they start raising interest rates. On the other hand, if it starts weakening, they lower. That's basically what they do. They're totally data dependent. Studies have shown they have no better forecasting ability than the private sector does. And by the way, that ain't so good either. So, they just sort of watch the data, make their decision as time goes on. All right. By the way, we often hear about these Fed funds futures. If you watch CNBC and all the rest, have to understand they're not unbiased at what they estimate. But let me just tell you, for the June meeting this year, that's halfway through. They have 8 meetings a year, 4 on the quarters. Those are the ones where the dot plots come out in economic projections. The June meeting comes at 4:15 now on the futures market. We're at 4:33. And by the way, that's an underestimate. So, and if we go all the way to the December meeting at the end of this year, it's 4:05. Well, that's like one cut away, and that's at most. If you actually put in the biases that I think are in there, it's basically saying no cuts. And most one cuts between 0 and 1. It really, given the strength of the economy right now, don't rely on that. Now, a lot of people say, well, Jeremy, how important is this Fed funds rate? Well, let me tell you, how about $15 trillion of loans are based penny to penny on what that rate is? $15 trillion. Ever borrow at the prime rate? Businesses, prime? Prime is set exactly 3% above that rate that the Fed sets. Exactly, to the penny. You buy home equity loans, prime -1, prime +1, depends on your bank and your credit. Small businesses. That's one reason why have small stocks not done well? One of the reasons they borrow at this rate. If that rate ain't going down, that hurts them. Big tech stocks don't borrow at all at that rate. They don't have to borrow at all. They have huge cash. Their equity is so high. So they don't care about the borrowing rate. Oh, yeah, it doesn't mean the borrowing rate won't affect their stocks because it's competition for capital, but it doesn't affect their profits. See the difference? On small stocks, the rate affects the profit. And on small stocks, it is the short-term interest rate. The short-term interest rate set by the Fed, penny for penny. So one person came to me, hey, it's long-term, it's a 2-year, it's a 10. Yeah, for certain companies, you want to buy long, that's right. Mortgages is long-term, unless you get an adjustable rate. Then you're borrowing right with the Fed. I'm going to give you an idea of the importance of the Fed versus the 10-year and all the rest. No, we're not really going to have very much. All right, now, long-term bond forecasts. The big 10-year bond, which is really important. I mean, everyone looks, they allocate between bonds and stocks. We have a 10-year bond. Under normal circumstances, I'm going to give you a graph. It's 100 to 150 basis points above the funds rate. So with the funds rate at 4 or 3.5 to 4, what I think is a long run, your 10-year bond is going to be between 4.5 to 5.5%. I think interest rates are going up under normal circumstances. By the way, the Treasury 10-year, I think, will fluctuate between 2 and 2.5%, which is where it is at the present time. I showed you this graph. Oh, here's some estimates of that R star rate. And the blue dot is where we are now at 4.33. The red line comes down to that. It really is a wide range. And I won't go into the details of that because this is done by research. Let me just say Holston, Lobach, Williams. John Williams is the president of the Federal Reserve Bank of New York, the most important bank president on the Fed outside of the chairman himself. He actually thinks it's low. I disagree with John. I've talked to John about that. Others put it much higher. As I said, I think it's really near the high point. So we just don't have much cuts coming in. And clearly that's true from the economy. Here's that graph. I wanted to show you the spread between the Fed funds rate and the 10-year yield. Seems like people have forgotten that. We've had an inverted term structure. What does that mean? We've had short rates above long rates for 2.5 years. That's unusual. The bottom line is the zero line. Most of the time you're above. Most of the time through all of history. It costs more to borrow long-term than short-term. Yeah, the lender's locking his money up for a longer period. It should cost more. I mean, it seems like, so right now, with the Fed funds rate of 4.33, the 10-year bond is what, 4.6, 4.7. It was tickling 4.8. It's still below the average. The average is 107, and if you exclude recessions, which we're not in now, it's 126. At 126 of the present one, you got 5.5. That's 80 basis points over the current rate. Ooh. That begins to get a little challenging, not devastating, but challenging. I just want to give you a long-term perspective. It seems people have forgotten that. By the way, I knew when the Fed dropped its rate 50 basis points that long-term rates were going up. I said, oh, that's stimulating the economy. They're taking recession off the table. We're going to get to a normal term structure. I mean, a lot of people said, oh, let's lengthen our maturity. Let's now lock in these long rates because they're going down. No, they're not. No, they're not. I had one friend call me the day after he lowered in September 50 basis points. He said, Jeremy, I'm buying a house. They're giving me, an idea. Should I lock in my rate or wait because, the Fed's lowering rate? I said, you lock it in today. He called me back a few weeks ago, thanked me. He said, I saved 100 basis points, 1 percentage point on that by locking it in. No, that was basically taking recession off the table, making sure the expansion continued, and normalizing the term structure. By the way, I support the move down. It was 5 1/3. That was too high. Now it's 4 1/3. It's gone down 100 basis points. I support that. And now we got a normal term structure. We are in the process of normalizing. It's the way it should be. We should not have short-term rates above long-term rates. That's an unusual situation. The money supply. Now, having taught at the University of Chicago for 4 years, the last 4 years, my first 4 years is teaching. 1972-76, as a young assistant professor. I was honored to be a colleague of Professor Milton Friedman. His last 4 years at Chicago before he retired. I mean, I had been following his work for many years. I mean, my PhD was in economics with a specialty in monetary theory and policy, and it was my dream place to teach and to start out. I learned so much from him. I remember sitting down at the lunch table, and he said how important the money supply is, which the Fed controls. He said, year for year, the money supply is not a good predictor. But there's two circumstances where the money is a really good predictor. And that is, if on the long run, if it expands too fast, you're going to have a lot of inflation. Too slow, you're going to have a recession. And secondly, if he pumps it up dramatically in the short run, you're going to have inflation. That's March of 2020. It was going up at a nice even pace. Everything was fine with the economy, and then bang. I saw that happen, and I was one of the very few people. I wrote articles. I said, we're just going to have a lot of inflation. It isn't temporary. It's permanent. The Fed is going way too far. They're keeping interest way too low, way long, terrible mistake. And finally started tightening 2 years too late in March of 2022 and almost strangled the economy. You know what happened to the stock market and bond market. Finally, we are growing again. Not quite at the pace we did before, but we're beginning to grow again, so we're back to a more normal situation. We would have avoided most of that inflation had we just kept that pace right along there. That was the primary cause of the inflation that we had, that tremendous increase. By the way, the increase in 2020 was the greatest increase in 150 years. Since Milton Friedman wrote the book Monetary History of the United States from 1871 to 1960. And, of course, we have another 65 years of history. Take a look. This is the traded commodity index, which just does include oil, but includes a lot of other traded goods. And you can see, I mean, the pandemic there in 2020 and March went down because everyone stopped buying everything, and then it started going right back up again with all that money being printed, speculation all the way up. Look at the speculation. I knew that that's not temporary, that's permanent, that's because of all the liquidity in the market. And we've been in a downtrend again. It's beginning to flatten out. Oil has come up and natural gas, part of the weather, part of the sanctions on Russia, etc. But it's in balance now. The commodity market, it's not really soaring, it's not collapsing. That's another indication that we are very, very near that neutral interest rate. Let's go back to the government debt I talked about earlier. Is it really a problem or not? This is a graph you often see, which is a long-term look, really from the early part of the 20th century. The debt to GDP ratio. Of course, big increase in World War II. Then we down. Now, by the way, we didn't pay down the debt. It is because GDP increased, and we ran a near balanced budget. So the debt wasn't increasing, and GDP kept on going up. But then we started increasing that. You can see what happened during the pandemic. Then all the inflation happens to wipe out some of the GDP increase, wipe out some of the debt after GDP. We're really not in a problem yet. The kink upward begins in 2035. That's when really the problem begins with the Medicare and Social Security, the trust fund running out. But we got 10 years, as long as we don't overdo it in the meantime. Now, the market looks ahead. So it's not going to wait to 2035 and say, okay, we got a problem. The bond vigilantes will be looking at it all the time. By the way, another way to look at it that I like to is to look at domestically held debt, because foreigners own 1/3 of our debt. It also shows a kink at 2035, but the level is lower. We had virtually no foreign held debt before. And then if you want to look at debt versus wealth, well, we're not even at the levels we were in 1945, 46. So, you know, I'm not a debt, crisis monger right now. However, I want you to see the following. Depending on which tax cuts he gets through, these are the different paths of debt over the next 10 years relative to income under the President Trump's hand. Right on the current trend, 125, the low-cost plan, which means very little of his additions, just keeps it there. Middle is 143, higher is 161. That could be a problem. That's what I mean about the bond vigilantes looking at that if he puts everything in. Of course, he puts everything in and the bond rate goes up, then they won't vote for it. The bond market will be the arbiter, finally, of what gets in and what doesn't get in. It's sort of, okay, we're going to look at it, and we're going to judge. Just remember that when you think about, what is Congress going to do? Stock market forecasts. All right. We have interest rates for bonds. We have price-earnings ratios for stocks. What I like to look at, and many others, is something called the earnings yield of the market. Now, the earnings yield is nothing more than the inverse of the price-earnings ratio. It's earnings divided by price. You guys all know what the dividend yield is, dividend divided by price. Well, take all of earnings, because not all of earnings are paid. In fact, only about 1/3 of earnings are paid out in dividends. The rest is buybacks and growth and all the rest. But the earnings yield is a very, very good estimate. Okay, so let's say 2024 looks like, of course, we're reporting the fourth quarter now, $233 for the S&P 500. Next year's estimate is $271. Now, I did this on January 14th. You know, the market's gone up or down, but it was 58.45, selling at 21.5 times 2025 earnings. That's on the expensive side, but not at all out of historical experience. I, by the way, think that the equilibrium or normal rate is about 20, should be 20. That's higher than historical. I won't go into the reasons. So we're a little bit above that. Now, 1 over 21.5 is 4.6% as a real return. You say, whoa, 4.6, that's below the 6.9. Yeah, it is. It is below. When you're at a higher ratio, that does that. However, we have to understand that we are in a very unusual market, and I'm going to depict it. You've often heard the term the bifurcated market. We have tech and the non-tech. And the tech is doing fantastic. And the non-tech is doing so-so, going up, but nowhere near as fast. It also doesn't sell for anywhere near as much, right? If tech earnings, if we take X-tech, the S&P is only selling at 19, which is actually below my long-run estimate. And that is a 5.3% real after-inflation return. Remember, I want to make sure you understand real. You know, say, well, look, I can get, 4.5%, 5% on bonds and all that. That's not real. That's what we call nominal. You're not being compensated for inflation. But stocks, you are. And only tips compensate you for that inflation. Stock return is still about 3 percentage points higher than bonds. 10-year tips is 2.3. I looked up this morning, it's 2.2. So bonds outside of the tech sector is 5.3. Now, the tech sector is very special. That 4.6% estimate assumes that tech earnings just don't grow any faster. The big boom of the past, that's the most pessimistic of all. But it is a very special sector that we've never seen before grow as fast and as long as this sector has. Let's take a look at this. You've often heard of the Mag 7. Here they are. Apple, NVIDIA, Microsoft, Amazon, Alphabet, Google, Meta. It used to be Facebook and Tesla. You see the price-earnings ratios. Well, actually the low 30s and 20s, except for Tesla. Really should take Tesla out. Why? Tesla, have it in the Mag 7. But Tesla sells on the promise of its auto driving and artificial intelligence. It's like an option. Right now, if you would value Tesla only on the basis of the cars that it sells and is expected to sell, it would be worth about 20% of its current value. 80% of the value of Tesla is all an option on how it could be. That it is further ahead than all the other companies at artificial intelligence, automatic driving, auto driving, and all that, which of course can be incorporated in Tesla cars, etc., and SpaceX, and his other enterprises. That is really where the value comes. So in a way, the others are based on their real earnings. So I often take out the MAG. I mean, if you take out minus Tesla, you have a price-earnings ratio of 30. Earnings growth, 21%. Trailing 5 years earnings growth, 25%. I mean, these companies have, as the expression goes, brought home the bacon. They've done it. They deserve these PE ratios if they can continue. If they can continue. That's the question. If competition comes in, we'll talk about that. The narrative changes, doesn't live up to its promises. That is often what is. By the way, I just want to show you about growth stocks versus value stocks. As you know, growth stocks are those that have high price earnings ratios, generally low dividend yields. Value stocks, lower PE ratios and higher dividend yields. And this is that's a 25-year picture on the top. That is the internet bubble that you see there on the left. And this is what's happened. Now, you say, oh my God, it looks worse. Got to remember, that wasn't based on earnings. That was just based on price and promise. This is actually based on earnings. It's different. So the price has gone up more, but it's based on earnings, not prices. We had a much higher price-earnings ratio back then than we did now. But I want to show you what really has happened, because this has really been quite remarkable, this sustained upward movement of growth versus value. We have never seen that in 100 years. It is the strongest performance of growth stocks versus value stocks in 100 years, since we had the 1926, it's called the CompuStat data set that goes back to that period. And by the way, let me just tell you, the trend line is not broken. Every so often, you heard, you get there and, growth stocks have a bad day and they say, these gurus come on and say, the broadening has begun. Now it's time to move into the other stock. Yeah, they've said that how many times? 50 times? Right? Has it ever been true? Not yet. And I look at the trends. Here's a short-term trend right there. It hasn't been broken. It surged in June, came back down. People said, it's over. The broadening has become, again, no. Here's a surge in December. They say it and say it. Until that trend gets violated. Until that trend gets violated, I don't think they're stopping these growth stocks relative to the value stocks. Now, the question is, when it'll be valid. By the way, value is cheap on price-earnings ratio, normally 71%, now it's 56%. So they're definitely, even though the earnings are there for the growth, the value stocks are very, very cheap. Is it time for small and value stocks? We've talked about this issue. Small stocks depend on those short-term interest rates. They're not going to go down much. Doesn't mean they're not, buys. I'll talk about that in a minute, but that's what's hurt them. That's why they have not rallied over the last 6-8 weeks. This is important. Markets are driven by narratives. And the current narrative is the AI narrative, artificial intelligence. That revolutionized. And to some extent, I absolutely agree. The internet revolutionized too, right? And then the stocks crashed later on. What could break the momentum? Well, certainly AI takes longer than anticipated to implement. We start getting stories. Only 5% of the firms have really kind of substantially implemented AI now. So even though it's been around for a number of years, not being implemented. Will firms be disappointed in the road? They may not get the results that they want. I'm not saying this has happened. None of this has happened yet. Will Mag 7 earnings decelerate with competition? Well, many of them are in the same fields. Dog eat dog. Well, they start eating each other's earnings, and all of a sudden the margins aren't there. I'm giving you examples of what could derail the negative, the narrative. None of that has happened yet. Not one of them. And in fact, history shows that when you have strong narratives, It takes more than one of them to break it. It's like, it's so strong, it needs to be punched until finally, hey, okay, I've had it. None of that's happened yet. This could go down and no one knows what's going to end. I'm not venturing. I just want to tell you that nothing stays on top forever. Right. We all know that. Cisco in 2000 was going to be the first $1 trillion stock by far, dominated all the router business and all that Wi-Fi business. It's selling at the same price that it did 25 years ago. IBM in the late 1960s controlled 85% of all computers. It's almost like an also-ran tech company today. Nothing stays forever, but you never know when the trend will stop. And we've never seen a trend like this before. So I'm not, I know you'd love me to go out there and say, hey, in June of this year, this will break, and the value stocks will come back. I'm not going to say that. However, once you have low valuations, you don't need much earnings growth to generate. I used to ask my students this question. What would you rather have? A 12 PE stock that represents the firms that has zero growth, but no shrinkage, can overcome inflation at prices it's good to, with the general price level. But if it's selling 1,000 widgets today, 10 years from now it'll be selling 1,000 widgets. No growth. Or would you rather have the S&P 500? History tells you you'd rather have that 12 PE stock. Surprising. I'd rather have a 12 PE, no growth stock than the S&P 500, which almost no one has been able to beat, as you know. Why? Well, 12 PE, what's the earnings yield on that? 1 over 12, what's it, 8 1/3? That's real, 8.3. Oh, and the S&P has only had a 6.9% real return in the last 200, 150 years. You don't need growth once you have low PEs. You just don't need them to disappear. Yeah. You don't need growth. Or they just grow along, limply like the economy. That's the difference. Nothing, with the growth stocks, everything has to go right. And it has been. But the value stocks, much can go wrong. You'll still be bailed out at the end. By the way, small stocks are also selling at a historically low rate relative to the bonds. By the way, this is international over here, of the different countries in the world, different indexes based on 2024 earnings, 2025 earnings. I've talked about the S&P, the Dow Jones, the NASDAQ. You can see 36, the highest there. There's Toronto Stock Exchange. That's the Mexican exchange, the BMV, the Bovapesta. Really, things are not going well in Brazil, as you can see, 7.8. But take a look at Europe, the second group, 14. That's pretty cheap. That's pretty cheap. FTSE at 11.9, 12. I heard the FTSE just hit an all-time high, actually. These are cheap in Europe, really, compared to the U.S. You take a look at Asia. Now, you see Nikkei is 20, but I want you to look at the bottom, which is a better index called Topix. It's more like our S&P. The Nikkei was based on our Dow, so it's a price-weighted index. Topix is selling around 15. You can see the Hang Seng in Hong Kong is selling at 9 to 8. The CSI is the Shanghai Composite, 14.12. And the ASX 200 is the Australian. The global index is selling at 18 times this year's earnings, 2025. That's a pretty reasonable number. But, look at the U.S. is selling at 22, so you take out ex-U.S., you're selling at 14, 15. Really reasonable. But as long as growth continues, it won't keep up with the U.S. Growth doesn't continue. With that, I'm going to terminate it by showing you this again, because it does set the stage for thinking about the market. As I mentioned earlier, all those little blips, the great bull and bear markets over time. Even the great crash of 1929 that bump there and then that bump down, which scared people out of the market for a generation. We economists call this reversion to the mean reversion, reverting to the trend line. And that trend line is powerful. And that trend line overwhelms the returns of every other asset class. Listen, we're going to have ups and downs. We're going to have, that. We're going to have a bear market sometime in the future. No one knows when. You're going to get anxious. I, too, will probably get anxious. So what should you do in that anxiety so that you don't sell out your stocks? Well, let me give you an easy plug. Buy a copy of my book. Take a look at this page. Think about it and say, you know what? I don't think I'm going to sell out now. I think I'm going to stick with the market. Thank you very much. You've been a wonderful audience. Thank you. We do have time. Thank you much. I will be happy to take any of your questions. Yes, sir. I'll repeat it also.
What's your opinion on cryptocurrency?
Yeah. Okay, let's talk about, the question is, what do you think about cryptocurrencies? The government have a strategic stockpile of cryptocurrencies. First of all, let's talk about should they have a strategic stockpile? Where's the money going to come from? I mean, we're running a $2 trillion deficit, so don't you think if you got any extra money, maybe you would want to pay down the debt rather than buy cryptocurrency? Now, some people have said, well, what we could do? Maybe we should sell some of our gold and put it in the new what's called digital gold, the cryptocurrency. Well, that's a possibility. That wouldn't be good for gold, though, would it? They would have to sell their gold to get the money to buy the bitcoins if they do that. So they're, are going to take the gold stock, which is worth probably around $250 billion. And should we take half of it, $120 billion, put in gold? I mean, that could be argued. Let me tell you about, no one knows about where Bitcoin is really going to go. I think Bitcoin, and by the way, in the 6th edition of the book, I've added Bitcoin. I used to call a chapter Money, Gold, and the Fed. Now I have Money, Gold, the Fed, and Bitcoin. So I've addressed the phenomena. A lot of it has to do, the rise of this international digital type of currency, because of the slowness and unresponsiveness of really the financial sector. And part of that's because it's under so many regulations. But, banks close at 3 o'clock, and you need to take money out at this, and you can't do transfers over the weekend, and try to do an international transfer that doesn't involve an awful lot of expenses. Bitcoin arises, hey, I'm going to have a world digital currency, store of value. That's strictly limited by mathematics. Now, gold itself isn't limited. As you know, gold gets enhanced, so I've read, by 2% every year by gold mining. So theoretically, a totally limited scarce resource should go up 2% more than gold, because gold gets added to 2% a year. Now, a lot of that depends on, that assumes that people still want to use the digital money, and that becomes something that people want to use as far as that's concerned. But I've often lectured about the fact that we should have a much more efficient payment system. And if we did that, I don't think Bitcoin would. We should have 24/7 transfers that cost you 5 basis points each to transfer. All the credit card stuff is terrible. Charging merchants 2.5%, 3%, and then giving you back 2%. It's a crazy system. Totally crazy. Europe doesn't have it. The other countries don't allow that sort of craziness. It costs consumers $600 billion a year, and they have monopolies. Visa, MasterCard, and American Express, totally monopoly. And financial system doesn't respond to it because they're making money out of it. Everyone's making money off of it, charging more. And we just don't have an efficient system. Now, with that said, I'm not going to make a forecast on Bitcoin. I do know, the question is, where is the money coming from? Given that deficits are going to be a really big problem to buy it, unless you liquidate gold. That's the only way I see it. And we have 5,000 years of history on gold. We were on the gold standard from 1721 all the way until, well, the 1930s. Internationally until the 1970s when the Bretton Woods Agreement ended. So, I mean, we had, the world monetary system was based on gold for 250 years, and gold has had value for 5,000 years. So, there's going to be a lot of people who are going to say, so we're going to liquidate this gold to buy Bitcoin. Honestly, I don't believe that should be a priority on the Trump administration. I know there's all the enthusiasts that want him to do that. And by the way, when that was mentioned, that's one reason why Bitcoin yesterday jumped 5% into the markets Friday. But I think that there's other priorities that at least I would pursue before talking about strategic reserve. Any other questions? Yes, sir. Or ma'am. Let's see. Yeah, so the CPI, and I've written on this, Consumer Price Index, they've made it much worse. The biggest problem with the Consumer Price Index is the way they do housing, all right? So this is the way that they do housing. Housing isn't based on the price of housing or the current rentals. They only raise the rent when someone leaves and a new person rents it. They do that with no other good in the economy. So as a result, for instance, the average American buys a car every 7 years. Do they only raise when you buy a new car? No. Every year, the new car prices get put in. They don't do that. I'm not going to go into the reasons. They have some economic reasons which I don't agree with, but that's the way they do it. So the result is that the housing data gets real lagged. My feeling is, and I wrote at the time in 2020, 21, 22, that if they had real-time housing data, which showed how big housing, and by the way, the housing market nationally from March of 2020 to March of 2022 went up by 45%, the biggest two-year rise in U.S. history, nationwide. I mean, some of the areas were much higher. I mean, like Florida went up like 70 to 80%, and the shores on Florida went up like 120%. But it was a nationwide phenomenon. We have never seen, even during the great housing boom and subprime housing boom of 2005, 6, 7, 8, we never had increases like that. And I was saying to John, Powell, don't you see what's happening, the speculation with all this money? Oh, no, our official indexes don't show much inflation, blah, 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 blah. I think that was a big problem. Now, so they underestimated on the way up. They're overestimating inflation on the way down. So it's a catch-up. It's like a distributed lag. So, and by the way, Europe doesn't do it that way. And we do, and I think it's distorted the figures by making them much lower than they should have been before. We actually had 10 to 12% inflation, but we actually have, if you use the current prices there, 2% inflation. We're down to the 2% level, actually. If you take a look at actual new leases from a year ago, rather than the expired leases, which might be 2 or 3 years old. So it distorted it. Other than that, I don't have any major complaints about the CPI index except for the housing. But housing is 41% of the core CPI and 30% of the CPI. So it is a real important source of shelter. Nonetheless, the Fed didn't seem to recognize this until about 2 years ago. Now they talk about it a lot. I was yelling about it right away, saying, hey, you're looking at the wrong data. The data is showing much worse inflation. You got to get on the ball much earlier than March 2022. Ooh, it was that way. And you can't go too far because once they crunched the housing market, as they did, to get it down to a more moderate increase, it's still creeping up on the official, but only about 2, 3, 4%. I mean, it was, as I said, it was a 20% per year increase from 2020 to 2022. So that was really, and that didn't show up in the data. Had that really shown up in the data, we had 10, 12% inflation at that time. And by the way, I remember Milton Friedman, and you look at the money supply, you said, look at where money flows. It flows into financial assets, big stock market boom, flows into real assets, real estate, speculative assets. Remember the NFTs, Bitcoin was rising hugely at that time. I mean, all of that is where that excess money was going. Printed by the Fed under the illusion that they had to keep on supporting the market, and they were buying mortgage-backed securities in the biggest boom in home history. They were still buying mortgage-backed securities. I could not believe it. Why were you supporting that market that has never had a bigger boom? Anyway, you know, I was a big Fed critic. He's doing better now because I think he recognizes things now, but certainly messed up early on. Anyone else? Yes, sir.
What do you think a normalized 30-year mortgage rate is? Because it seems like you're saying we're coming to a more normal. We're at historic lows for so long. I mean, it's a big driver in the economy for the housing sector.
Absolutely. Well, very honestly, I don't see under 7%. I mean, I think 6.5 to 7.5, maybe 8. I mean, I think we're in the range now, and the 10-year mortgages. I mean, listen, mortgage people have been, the mortgage holders have been burned so much, right, from that rate increase. They're just not going to lend out mortgage. You know, it's a one-way option. If interest rates go down, I prepay the mortgage, so the holder of the mortgage doesn't get it. And if they, if the rates, go up, then I'm left with a low-yielding mortgage. They got to price that in. And they've been burnt so badly. That's one reason why the 10-year is at 4.60, and the 30-year mortgage, which by the way has a duration about the 10-year, the same duration is now at 7.25, no points. I think you've got to expect 6.5 to 7.5. And by the way, if Trump tries to push too many tax cuts on the bond vigilantes, get upset about it, and raise the rates, you could go to 8 on the mortgage level. That'll keep the housing market quiet, when no runaway as a result. Already the increase in rates has prevented the runaway of the housing market. Anyone else? Yes, sir.
What role do you think that artificial intelligence is going to play in creating efficiencies that would affect investment strategy?
That's a very good question. I will admit that I am not an expert on AI. I read a lot about it. It should be efficiencies across the board in so many areas. Clearly, self-driving is huge, and anyone that the truckers and drivers, well, there's 1 million people employed. I mean, are they not going to be employed? That is absolutely a huge area. But any back office type of stuff that AI can replace, people writing text and doing research and all that. However, I think AI is amazing, but I see its limitations. I won't go into them, some of the things I've asked it to do. Some people have taken talks that I've made and gave it an AI, and it just doesn't sound like me. I mean, it has most of the information, but it's not the emphasis I would put in, so I have to edit it. I really have to edit it to give the right, one. I mean, it's good language. They have a richness of vocabulary, that would make it, a high school teacher would think, oh, this is well written. This guy, has that. But they almost overemphasize some parts and underemphasize other parts. And I won't go into other things that I've asked it where I know it's done wrong, absolutely wrong. I'm not saying I'm using the chat GPT. I mean, there could be others that are better, but I actually know the answer is wrong. And I'm not saying, oh, this is useless. It isn't useless. Self-driving cars, are people going to go in them? Are you going to get used to them? How is it going to happen? I know I'm almost there. I know that Randy's waiting for me. I mean, do you know that I read a story about, we're talking about self-driving cars. Not a story, a true thing. The automatic elevators. Back in the 19th century, there always used to be an elevator man. You go in and he would always. Then they went to automatic elevators. I think it was the 1920s that they began. Half the population would not use them. They said, I'm not going into this elevator without someone there. Think I'm crazy? I was to get stuck and I don't know what to do. Now, I don't know whether the same thing, that sort of resistance is going to happen when people say, I'm not going into this car. There's this NASDAQ ad where this guy gets driven, and he said, this isn't the right way, and there's mysterious movement, mysterious music sounding in the background, and he said, that's right, Don, we're not going the way you think we're going. And all of a sudden he pulls up, and they go to someone's house, and they're throwing him a surprise birthday party. Well, I think that's the scariest thing I ever saw. I looked at that, and I said, someone hacks your car, they can drive you anywhere and lock the doors, and you're not getting out. I said, okay, that reminds me, I didn't know if that was a positive or a negative. They thought it was just so wonderful in terms of what it could do. So, some of these things, is it a evolution or is it a revolution? It's going to have to be sorted out over time. Anyway, you've been a great audience. Thank you so much. Randy, thank you for inviting me here. Wonderful. Yeah.
So I want to thank everybody for coming. We will have a recording. Hopefully you'll check the concert, some of the other things. Drive safe. Have a great weekend.